Hello, everyone. Welcome, welcome. So glad you've all joined us today. Hoping you're all having a fabulous 2023 and happy Tuesday. So today, Paul King, CEO of King Wealth Planning and LPL Registered Principal, and Jeremy Olin, National Managing Director of Mariner Advisor Network, will be discussing markets, the global economy, and the opportunities and challenges that may lie ahead for 2023. A little bit on Jeremy. As I just mentioned, he's the National Managing Director of Mariner Advisor Network and leads its portfolio consulting team. He's responsible for supporting King Wealth Planning and how to best leverage investment tools, strategy, and technology to support our practice. Jeremy's prior experience includes the establishment and management of a natural resource hedge fund and has published 2 indices and launched 2 ETFs. And in addition, Jeremy developed the quantitative allocation methodology for the design and management of investment portfolios. Jeremy has presented for us previously, and we're so thrilled to have him back today. Welcome, Jeremy. Before I hand the mic over to Paul and Jeremy, I have some need-to-know items to cover. First, today's session is being recorded and will be available through the King Wealth Planning website, which is kingwealth.com. Next, we'd love to hear from you during today's presentation. Due to compliance regulations, the chat feature is disabled. If you have a question, feel free to send your question through email to me at shannon@kingwealth.com, and we'll address questions at the end of the session. All right, well, that concludes my need to knows. Paul and Jeremy, over to you.
Thank you, Shannon. Welcome, everybody. Our theme of our presentation, or really conversation today, is finding balance. And after the last couple of years, it's probably no surprise that we're striving for more balance. We've had, so many ups and downs in the economy and supply chain issues and ravaging inflation. So it's always great to have a conversation with Jeremy and his whole team. We're in regular conversations about investments, economy, and how those are tied together. So I don't know all of his presentation today, but we'll have a go at it. And I really like this graphic. If for those of you who are hikers may recognize it a little differently than those that aren't. But if there's a kind of poorly marked trail, the first hiker through will build one of these. They're called cairns. It's just a set of rocks balanced on each other, and it really points the way. It navigates for the next person coming through. It's a little help, and that's kind of where we'll look at it today with Jeremy. Is what direction are we headed in? And if you see the market today, it's up dramatically, down dramatically, back up, and it reminds me of the decades ago when we used to say, if E.F. Hutton speaks, people listen, and now it's Jerome Powell speaks, people listen to every word. So Jeremy, I'll let you take it from here, and I'll pop in with a few questions or comments along the way.
Sounds good. Thanks, Paul. Thanks, Shannon. Thanks, everyone, for having me back today. Forecasting the market is a difficult job, to say the least. And so I agree with you, Paul. I hope that we can find some balance after the last many years of COVID and inflation. And really last year was so rough because we saw interest rates rise so precipitously, which drove the bond market down and also drove the stock market down. And that makes for a really rough year as a portfolio manager and just working in capital markets, because it's really hard to find balance or diversification benefit. And there are years like that, unfortunately. So let's talk a little bit about what we see coming here in 2023. And good news is we do not see an economy anything like we saw in 2022. And if you jump to the next slide, I'm going to jump into 2 really important measures. If you heard me talk about, if I presented before, which I did, I'm always going to talk the economy. And a lot of times I'll talk about the economy and the markets a little differently because they're not entirely the same animal. And we can talk a little bit more about that later, but it is really important. Of course, the market is forecasting the economy. And if the economy is healthy, generally we're going to have a healthy market. One of the measures we like to talk about when we talk about our economy is GDP, right? Gross domestic product. If we added up all the goods and services that the US economy produces, we could measure it. We put a dollar value on it, the trillions of dollars. And if it's growing, that's a good thing. Our economy is growing and that's GDP growth. And so last year was pretty bad, right? We didn't have really GDP growth last year, but historically, about 3% is average in the US. And so when we start to look at GDP growth, you can see it's pretty modest. It's only about 0.5%, which is still positive. Doesn't mean we're necessarily going into a recession, right? That's consecutive quarters of negative GDP growth. But that's really on purpose because I think, as everyone knows from last year, that other key measure, and we want to keep our eye on forecasting it, is that CPI number, right? That measurement of inflation. And probably goes without saying, the last year the Fed acted very aggressive. Our Fed, the Fed around the world did, pushing interest rates up to slow those economies down. And we're seeing this in 2023, that they're all really going to slow down. You can see China and the emerging markets there at 3.5%, kind of maybe going to lead the pack in 2023. But all those inflation numbers have really come down. And that's a pretty good place for us to be right now. Jumping into
some of Powell's comments today was that he sees, very moderating. I think that's what's leading this rally. And it's said over and over this past year it's almost the business was too good. And we had inflation for a number of reasons, but partly was, full employment and, really good profits for companies. And yet the Fed wants to control inflation. They got to bring that down. And we see a lot of layoff announcements. We saw incredible high numbers of new jobs produced, but there will be layoffs coming. It would be a little bit different.
Yeah, it's going to be interesting. And to your point, Paul, right? Last year we had consecutive quarters of negative GDP growth in the US. And if you Google it, that's technically that's a recession. However, there's sort of this caveat where if the job market is so strong that you have basically zero unemployment. I mean, there's always going to be some measure of unemployment just because, but there's way more jobs than people look at. That's still the case, right? So technically, and I would agree with this, the Fed said, no, even though we've had contraction consecutive quarters, we're not going to call the US in a recession right now. But seeing those inflation, and we are definitely seeing that. I've got some more slides on that. We're seeing inflation really start to moderate. And that 3.5% forecast for CPI here in the US is pretty modest compared to where we were at last year. So if we look at leading economic indicators, and Paul, you just hit on this, okay? A leading indicator is like new home builds, people spending money on goods and services to propel their business. All these leading indicators. This chart, that blue line, is showing what's known as the leading economic index. It's about 10. It's an amalgamation of 10 leading indicators. That's coming down. You can see historically where it's come down, and those gray bars are where we've actually had recessions. Of course, that big fat one, if you slide over to the right on the chart in 2008, you can see all the leading indicators coming down, down, down. We had a recession, and then we've kind of come back, through this next part of the decade. You can see where we're at here in 2022. The things are cooling off. That's why those inflation numbers are coming down. course, we don't want to have a recession, but you've got to be careful with the term recession, because not every recession is the same, right? You can talk about a recession as far as its length and its depth and how many different sectors it hits. And so, we may have a recession, but again, we're thinking, even if we do, though we're forecasting still to that 50 basis point, that 0.5% growth, we're thinking it would probably be a pretty mild recession. We can talk a little bit about that too, because by the way, most of the time markets come down before the recession hits. And then we have a recession, and oftentimes that's when the markets start rallying. And that's the important differentiate when we talk about the economy versus the markets. The markets are always looking forward, even now, 2-3 years ahead. And so if it sees us coming out of a recession, market's going to rally before the recession's over. Next slide.
Watching the Fed, it's a very data-driven market. They're looking at inflation and a number of other factors. And, I think a number of forecasters were wondering whether the Fed was going to take things too far, right?
Yep.
Try to bring it down too fast and get inflation under control. And now we saw, 0.25%, much more moderate, then some commentary around inflation moderating. So, hopefully they're forecasting it like you're talking about is the same as we're talking about, is like, okay, if things are going to moderate later, we don't need to put the brakes on so hard right now.
Yeah. And I would agree with that. And that's really good news as we're seeing Powell's comments coming out. And it would appear that they're paying attention to the data and starting to moderate those rate hikes. Not to get political, but I would argue they've done a pretty good job of jumping all over the inflation thing. As much as it hurt last year, in my opinion, it was nice to rip the Band-Aid off. And every other country, right? Eurozone, the UK, Germany, we're all having inflation problems. Nobody reacted more quickly than the US Fed. Everybody's raising rates, but nobody did it more aggressively than we did. But I think it's kind of nice because Germany's still struggling, right? They probably are more likely going to go into a real recession than the US. And so, I might argue they've done a pretty good job. The one scary thing about the Fed, though, was despite some of the inflation numbers coming down, right? Cost of goods, durable, non-durable, all those things, they wanted to see a weakening of the labor market as well. And we're not seeing that. Yes, there's layoffs. All those people are getting jobs. That's, they're not going into the unemployment pool yet. It's been pretty amazing. I would argue no economy reacted better to COVID than the U.S. Economy in other ways too, because we're so innovative and we so quickly have shifted from manufacturing-based to service-based companies. And so, I think to our credit, we've got an amazing, extremely resilient job market, and that's going to keep the economy going. And that's why, despite the rise in interest rates, some of those inflationary pressures coming down, U.S. job market remains strong. Hey, 70% of the GDP is based on consumer spending. If the U.S. consumer spending, the global economy's rising. And by the way, a third of that, 70% of our GDP, a third of consumer spending is going to housing. And we just talked about, despite all, we all know what the housing market has done. And I'll always tell when the top of the market, because I bought a house last year in Tahoe. So that was probably the very top of the California housing market. If I buy, you can pretty much bet it's coming down. But good news, it is coming down, and that's going to put a lot more money in the consumer's pockets to also go out and buy other stuff and spend money and keep our economy going and not into a recession, and hopefully get back to that 3-4% GDP rate, which would also translate into positive earnings growth on our S&P 500 companies and other companies that, you and I buy for our clients. And so that all translate into a pretty healthy economy and subsequent market. So, some thoughts on stocks. I mean, we've already hit on it quite a bit, but historically, I think it's important to note it's not the first time we've had rate hikes, and almost always after those rate hikes, historically, the markets rise, right? And a lot of the factors where they didn't rise were where unemployment, right? We had mass unemployment in some of the recessions of the past, et cetera. And so a lot of times where the markets haven't rise, some of those other factors weren't in place. So we think we're likely in that place where markets do rise, whether it's 3, 6, 12 months after the rate hike cycle stops. Next slide. And of course, I think, hopefully we're all seasoned enough investors to know, guess what? 70% of the time the market's up, and generally after it gets hurt, like it has, and we're talking about both the stock and barn markets, by the way, generally after those periods of time, right? You buy low, and you can see historically, if you scroll over to the right there, right? On average, the market's rallied. I think it's 11 or 12% in the years after it dropped, and certainly some years much more than that.
And I was looking at some analysis today. The stocks that were hit hard the most last year are up the biggest this year, up yep. On the order of 40%, and some of those that weren't hit so hard aren't up much, right?
Yeah, that's right.
A lot of that's tech stock recovery and things like that, but it's just it's the tail end of the distribution of all the stocks.
You bet.
Natural. And that's I think that's the whole thing about diversification, right? Is that we preach is keep you in the game, right?
Yeah.
Through all these ups and downs. And a year like last year was hard to feel like diversification was helping with both sides coming down. But I think we'll see a reversal this year for sure.
Yeah, that's right. And as we know, it's when these things snap back, they it can happen in 3 or 4 weeks. You'll recover half of last year's entire loss. One of the most important factors we're always going to be looking at is earnings growth, right? Because we own stocks, and for them to really appreciate in value and pay dividends, et cetera, there needs to be earnings growth behind those companies. And so the consensus earnings per share for 2022 was the blue line. Consensus S&P for 2023 is that orange line. So earnings growth coming into 2023. At LPL Research, we're taking a pretty conservative approach and saying, actually, this is going to be a year we're not forecasting. It's that dotted line down below those other lines. So consensus is all those analysts out there in Wall Street saying, yeah, this, General Motors and Ford, they're going to all have earnings growth, Microsoft, et cetera. And we're saying, hey, we think it's going to be hard for companies to make a bunch of money this year, and we're kind of conservative on that earnings growth. Flat line is okay, especially if you start to see earnings growth into 2024, et cetera. But we are against consensus here and saying we are not expecting to see a whole lot of earnings growth. If we did, we would take our S&P estimate much higher than it is right now, which, by the way, I'll spoiler alert into some slides ahead, right? We're estimating the S&P in 4,300, 4,400 range. That's not a whole lot higher than we are right now today. So, and I think this, hopefully this slide's coming across a little bigger on your screen than mine, but really, if you look on the left side, the y-axis, right, talking about the economy, that inflation, what the Fed's going to do with interest rates, earnings. We'll get a little bit into geopolitics here, et cetera, but all the things that we're talking about, creating this puzzle for us to start to create some cases for 2023. we're assigning a 60% probability to what we're calling our base case, which is really everything I just talked about. We don't really have a recession, or if we do, it's a very mild one. The Fed slows down interest rate hikes, maybe even pauses because inflation really starts to come down. There's no craziness necessarily in China or the UK, and et cetera. And you can see that base case there, 4320 on the S&P 500. And also really thinking that sets us nicely up for 2024. Again, hard to predict these things just because we're estimating 4,300 in the S&P 500. 4,800 wouldn't surprise me at all on a base case there at all, right? These ranges can swing pretty wildly, and they're not really time bound to 2023. We're talking about the next year. The bull case, right? Much softer landing, economic growth comes back, inflation falls, no more problems in China and COVID and all that. And we're seeing a 5,100 on the S&P, and then I'll spare you guys the bear case, but that's more persistent inflation, more interest rate hikes, et cetera. And that puts us at a downside there. Call it 3,700 on the S&P 500, which we are all familiar with. We were just there last year. So,
hey, Jeremy, I think this is a good slide to just point out for our listeners is, these are the types of conversations we have all the time. Here's all the possibilities. What do we think is going to happen? And then, we have a strategic program we follow, right? Because most of the portfolio is kind of designed for long term, but we want to tilt some tilts occasionally, but only if we have high conviction around something. So when we see the base case is a 60% chance, that's more our conviction, right? And then tilt the portfolio to those things that make sense in that scenario. We're not right all the time. Nobody is, but I think we're decent at forecasting, and only those areas we think are really likely to pan out. Not, oh, gee, we hope that the bull case happens, so let's get into the real high flyers and then get hurt, right?
That's right. That's absolutely right. We like, this is a game of probability theory and finance, and so that base case is going to be where we're looking pretty hard at. Mm-hmm. So that's the stock market, by the way. But here's the really good news. This was the bad news last year, but here's the really good news. We're just talking about the stock market. The bond market, we have much better expectations for over returns. And again, we've got a bear case, a base case, and a bull case, put out here. But basically, in our base case, right, as we talked about, interest rates, the Fed stops raising interest rates, and we really stabilize. And I'm just going to take you to that 10-year Treasury yield across the bottom. Hard landing, we're in a recession, so the Fed has to cut rates again, and rates come down to 2.75%. That would be real bummer because we're actually able to buy 2-year Treasury bonds paying 4.3% right now. And it hasn't been like that in a really long time. And the risk-adjusted return on a 2-year Treasury bond paying over 4%. I mean, there's risk on a 20-year Treasury bond, this duration risk. If rates jump around, those bonds move around. That doesn't happen on the 2-year. And so, and I'll jump into the next slide, but we really see that 10-year coming in at 3.25, 3.75. That's a really healthy rate. But you can take a look at the different scenarios of what we would get out of our bonds. So we have a recession. Fed's like, oh, we overdid it. Hey, could happen. Happened in, it's happened in other countries in recent history. We're like, you know what? We overdid it. We're going to drop rates by 1%. We get 12.3% jump on our bonds. Bam. Right? Or we have stagflation and they keep raising rate, and it's a bummer, but we still are not losing money on our bonds. The bonds are giving us 1.1% worst case. So that bond market profile is pretty attractive to us for a couple reasons. Solid returns, and this, once again, until rates go back down to, horrific levels like they did during COVID, we're going to get diversification benefit and return. And so we're really excited that we can much more comfortably own both stocks and bonds together and use them in a portfolio context to get diversification benefit. So again, more bullish on bonds right now per se than we are on stocks for 2023.
Jeremy, I know you're a hockey player and know the famous Gretzky quote of skating to where the puck's going to be, right?
Right.
And that's where I think, again, as an example, we did more changes in the bond portion of our clients' portfolios, and that's the majority of what they have, more people closer into retirement. So, we did short-term bonds, we did treasury, inflation-protected bonds, and now we have to make that shift, right? The
Yep.
environment's going to be completely different moving forward.
Yeah. And we won't be rushing to do it. We have an inverted yield curve. Rates are actually higher right now at the shorter end of the curve, but we're starting to get real interested in more credit, high yield bonds, duration, those things will be coming, but we're pretty happy just, kind of taking our time and sitting on that short end of that curve. But the shopping has begun, right? I mean, and that's true. You mentioned some of those stocks popping. I mean, there are so many assets right now that have repriced and are on sale. It's actually, it's been a lot more fun to be a portfolio manager this year than it has in, the last 2 or 3 years, where it was just like, we were buying bonds, like you said, we were using treasury in, the bonds that adjust with inflation and such, but still it was really challenging environment. So again, the bond market is in really good shape, and the debt market is also in really shape. Less than 10% of outstanding debt needs to be refinanced before 2025. So all these companies locked in these really great loans, right? For some of us who bought mortgages, it's like we have this debt, we may never see it again in our, it really was unbelievable. And so the debt market is in really good shape. You're not going to have a company that, thought they were going to be able to have a loan at 2% or 3%. All of a sudden that's adjusted to 8%, and they got to file bankruptcy and default on that loan, et cetera. We all remember that from 2008 and such, what happens when the debt market starts to default. That is not the situation we're in. And corporate America is actually in really good shape from a debt to equity and debt payment level. The geopolitics, frankly, is the one that kind of keeps me up at night. And predicting China and what's going on over there, and COVID is going to be really tricky. You can see look after 2016. And what has happened to their economic growth, turning on and turning off again. And of course, China's such a beast, right? That's going to drive all kinds of prices, and that can make things pretty unpredictable, especially right when it causes commodity like oil. China GDP jumps, they put a huge demand on oil, boom, we have inflation here again. So, little bit unpredictable. Our sense is it's going to stabilize, but you just never know. And then, goes without saying too what's going on with Russia and the Ukraine, and you could throw Taiwan into the mix, et cetera. So these things are very difficult to predict, other than, again, good U.S. companies, bonds for diversification, all-weather portfolio, and if there are drops in the markets, we use those as buying opportunities.
A couple of points on China. They reopened the border fully with Hong Kong today, and then, of course, we got the State of the Union speech coming up with the, Chinese weather balloon.
Right.
So, it's good news, bad news. We'll see what, if the U.S. puts any sort of economic pressure on for that kind of situation, but it doesn't help, kind of the political side of that equation.
It doesn't. So, just kind of some fun facts. If you guys have heard me talk in the past, I actually don't put a whole lot of weight into some of these statistics, but they're pretty fun to look at. To include, right, you probably hear us, we're fairly bullish on the market here in 2023. again, way more on the bond market than stock market, but it's of note, stocks have always gained a year after the midterms, no matter who's in office. So if you want to put that any weight in that, we're going to finish 2023 up here
Well,
positive.
I was having that conversation with a client this morning. You know, it's not the president that controls the economy, it's the Fed chairman or
Exactly.
Fed committee.
That's
You
it.
know, they're much more, and then they're held over between administrations. So there's a lot of statistical noise around the political side of it.
Right, right. And this is true until it's not. So again, some fun slides as we kind of wrap up the initial part of the conversation here, but jump into the next one too. Won't be long before we have a new president or a presidential election too, and kind of interesting. The market returns are, sometimes people are surprised to hear this, but higher when you have a Democrat in power than a Republican. So Democrat averaged 12.5%, Republican 9.4%. Now, even higher if you've got a Democrat president and a Republican House and Senate, right? Versus split. But kind of interesting, one of the highest ones is Republican president split. Anyways, just some more interesting statistics. What I like about this most is, guess what? Generally speaking, the markets are usually up. I mean, look at those returns, right? And so sometimes after a year like last year, it's pretty hard to remember the years that came before it, and the amazing run that we have had, and I would argue will continue to have in the stock market, no matter who the president is.
Well, and most of us have time frames that last longer than an administration, so
That's for
we're
sure.
gonna live through all of them.
That's for sure. Hey, so that's really the gist of the presentation, but certainly got plenty of time and happy to take try to answer any questions you got.
Do we have any write-ins, Shannon?
Yeah, just a reminder, we're moving into the Q&A segment. If anyone has any questions, go ahead and email them to me at shannon@kingwealth.com, and we do have a couple. So first, are other countries raising interest rates like the US? I know Jeremy had touched on Germany and that they're not doing too well. So just curious about that.
They all are, pretty much. Even Japan, they're all raising interest rates, just not as they did not react as the US has absolutely led the way.
Well, you think, historically, not too long ago, there was negative interest rates, right?
That's right. That's right. So, love it or hate it, we definitely led the way. But yeah, you're seeing those rate hikes, whether it's in the UK or Eurozone or Japan.
Okay, and can stock prices rise even while the economy is in recession?
So interesting question. I was trying to touch on that early. Not only can it usually does. So the stock market will generally rise before the recession ends. They generally fall the most before we even call it on a recession. So by the time they've fallen like that, you have a period of recession. Again, that market starts to forecast as soon as it can see it that we're coming out of it, the market's going up, even if there's still contraction in the economy as far as GDP growth goes. So, again, it's really important to remember the market is always looking forward.
Okay, and since bonds are looking up, what are the best types of bonds to invest in this year?
All of them. Yeah. So I mean, the shopping list is really great right now. We look at risk-adjusted returns on the bonds, right? So even, if I look at a high yield bond, which could fluctuate more, than a 2-year treasury bond with interest rates or, some economic, some volatility, et cetera, the risk-adjusted returns even on high yield bonds are pretty attractive to us right now. We're fairly conservative, so really the plan on the year is to come out of some of the more conservative, shorter duration bonds and start to shop into some of the longer dated and more high yield or high credit bonds, because we're going to like picking up higher coupon on those. So we'll be shopping all year out of the conservative short-term bonds into some of the, we're always going to hold some of the short-term conservative bonds, don't get me wrong, but we'll start to lengthen our duration and pick up, get paid for some credit risk as well.
And we, your team and I already started deploying that across some of the strategies, and like you said, slowly implementing it across the different portfolios.
Yeah, it's a no-brainer.
So talk about, though, one of the big emphasis we put was on mortgage bonds over the past few years, tend to be, more stable, good income type of investments. But with the spike in interest rates last year, good, bad, and different, what do you see, moving forward? We've held that position and probably will continue.
Yeah, and I think that's now it's an even just stronger position to continue to hold, because those securities are backed by assets that really, yes, they've stabilized in value, but they barely depreciated, right? So your default risk is very low, because even if someone stops paying their mortgage, you get to recover the property, and think about how much the properties have appreciated. And as mortgages now continue to get originated with higher yields on them, we're just getting paid more interest on those loans. And so the whole asset-backed and mortgage-backed security space is still very attractive to us, despite taking some punishment, as you do when you hold loans only paying 4 or 5%, and now the market is 9.5% or whatever. Your loans are going to get marked down, but you'll recover that over time.
I've got a question we haven't really explored before, and it's kind of at the periphery of some of the stuff we're doing, but it's around oil and gas prices, and we know what happened with the pipeline, and we've hurt supply and the cancellation of the pipeline here. But it was years ago when Alan Greenspan spoke to an LPL group and made the point that even if we pump more oil, we're really limited on refining capacity. Do you know if that's still true? Is that there's a lot of reasons for the high cost of energy right now, but would that feel like a problem going forward anyway?
Yes. Yeah. Interesting question. And yeah, to some extent, I mean, yes, about 55% of the oil price is just going to be dictated by the supply and demand of oil. But the person asking the question is right. Actually, it's kind of interesting, right? There hasn't been a major oil refinery built in the US since 1976, I believe. Right. So we have not invested in the infrastructure to actually refine the oil and get it to the pumps. And so that other 45% could be dictated by a bottleneck just there. Right. So even if you had tons of supply, it's just, that's only going to impact about half the cost. The other is going to be just that the inability to refine or process it. So yeah, that's an issue. And there's no investment on deck to do anything about that. So
I wonder how much incentive they have with maintaining high prices. So
well, yeah, I mean, we occasionally, my team and I will pull Chevron's balance sheet apart and their profit and loss statement, and they're doing pretty good.
Pretty good. Yeah. All right. Any other questions, Shannon?
No, I don't have any. I think that's a wrap.
All right. Well, we appreciate everybody's attention, and we'll reconvene in 6 months or so.
Yeah,
sounds good.
Thank you all for participating. Thank you, Paul, Jeremy.
Thank
for
you.
bringing this great information to us. We wish everyone a safe and enjoyable week, and we will see you at the next one.
Take care, everyone.